Deputy Murphy.
Thank you, Chairman, and
Good evening, Deputy Higgins.
thank you, Mr. Neary. There's two areas I want to touch on, if I may, before we conclude this session. On page 11 of your opening statement, you said that apart from considerable day-to-day contact with their respective banks, staff and banking supervision carried out over 50 inspections of banks between 2003 and 2008. Are you presenting this as a positive?
Well, I'm presenting it in the sense of what was achieved by very tight resources. And unfortunately, the relationship did not necessarily, I think, achieve a measurable outcome. I mean, the reality of it is that despite that level of oversight, intervention and engagement, we got to the unfortunate situation where we found ourselves at the end of 2008.
Okay. In a report from the Controller and Auditor General in 2007, a special report on the financial regulator, he criticised the level of on-site inspections. So what did you do as a result of that criticism?
He certainly put quite a range of findings in front of us. I think he did it on the basis of value for money. And I think it was in that context that... I
can give you the context, if I may. A central concern in the special report was that the inspection levels were low and that risk rating was used to ration resources rather than determine an appropriate regulatory stance for institutions. That's in the CNAG's special report of 2009, and it's referencing the 2007 special report.
Is it in the core documents?
It's not in the core documents, but the regulator is aware of the report.
Okay, fair enough.
Yeah, I can recall the value for money report that was done in 2007. And the selection by the supervision staff for the inspections that they were to carry out, I think, derived from the internal risk rating programme that they had in banking supervision, which took into account of a wide range of factors. There was an annual review that they did. They had a well-established procedure in banking supervision for determining the inspections. But I think his view was, in terms of value for money, what outcomes were coming from the inspection, etc. I only partially recall that. I'm not
He did say that the on-site inspections, the level was low, and you just mentioned the determination of how they carry out the inspections, the risk rating.
Yes.
And the CNAG criticised that as well in 1999 and in 2007. And what did you do about those criticisms?
What did he say in 2007 in relation to the risk rating?
He said that successful reports, sorry, I don't have the CNAG's report in front of me, it's actually the Honan report on page 64.
Okay.
Successful reports of the CNAG have urged improvements in the methodology, and that being the system evaluated risk using such factors as supervisory complexity, corporate governance, business and reputational risk, and so on, based on regular statistical reports provided by credit institutions on their activities and financial conditions. And I suppose, Mr. Neary, my point is, or my question is in relation to the criticisms coming from the CNAG about the level of inspections and the methodology being used in carrying out those inspections to evaluate the risk being taken by the banks, and what your response was as financial regulator to those.
I can't recall the outcome to that engagement with the CNAG. I can certainly confirm that the inspection took place and that there was engagement with him. The action plans that were put in place to address his concerns, I cannot recall them, Deputy.
You say those concerns were addressed?
I would expect so. I mean, the CNAG's recommendations would not be set aside.
In 2005, you had a three-person team responsible for both Bank of Ireland and Anglo-Irish Bank in terms of those inspections. Was that an adequate number of people?
Certainly, with hindsight, definitely not.
Okay, so could you have known what was happening in the banks, in those two institutions, with those three people?
Well, it was a combination. Our source of data would be a combination of a number of different sources, from the prudential returns, from the engagement with the banks, from their annual accounts, and so forth. In the context of a principles-led approach to supervision, and with the model whereby boards and management were expected to take charge of the risk management of the organisation, the answer to that is probably yes. But with hindsight, that was clearly not correct.
The answer is that yes, that three-person team was sufficient for giving you a level of information.
In that context of principles-led regulation. Now, because on top of that, there was a further resource that carried out the inspections. The people that we're referring to there were the people that had the day-to-day relationship with the bank and dealt with any ongoing issues or issues that came out of the inspection process. Those people then took that on. Now, but clearly, I think as we moved through the decade and as we got closer to Basel, it was clear that the resources were becoming much more thinly stretched, and that's what prompted Mrs. Burke to look for the additional resources.
Okay, I have to move on because my time is short. If I could look at just stress testing, if I may, Mr. Neary. The stress testing that was conducted in 2006, and there's a reference in the core documents, volume 3, page 35. Volume 3.
Yeah, okay.
The 2006 stress tests, were you involved in designing those stress tests?
No. No.
Just requisite.
Okay. The financial regulator wasn't involved in deciding on the methodologies or the variables?
I'm not saying the financial regulator wasn't involved in them. I think we would have been informed through the Financial Stability Committee of the stresses being used and the factors being used. It was this functionality was discharged by the economists and people in the financial stability area. So, I mean, it would have taken account of any information we'd have provided from the Bank of Supervision people.
So you've been aware of the scenarios being put in the stress tests to the banks?
Well, I was aware that they were supposed to be conservative, and I trusted the process that the conservative stresses would be used. I didn't get actively engaged in setting those parameters, and I think that's a skill set that I think is more appropriate to the economics people.
If you could help me clarify, because there was two scenarios put to the banks to test for. Shock scenario 1 was the extreme scenario, and it had a number of variables, and one was a decline in house prices by 40% in the extreme scenario.
Yes.
Shock scenario 2 was the weak scenario, and it had the same variables at different levels, but the decline in house prices in the weak scenario was still 40%. Why would that variable be constant amongst both the extreme and the weak shock scenarios for the bank?
I'm not able to answer that question, but the only additional point I would make in responding to you, Deputy, is that as far as I remember, in 2006, the stress test process was validated by the IMF, so it would have met their requirements.
Well, actually, the IMF, if I can find the document in front of me, the IMF, the central bank oversaw the stress test results, and the IMF did comment on them.
Okay.
And the IMF said that they welcomed these results, but observed that the long period of strong economic performance limits the ability to quantify the relationship between macroeconomic variables and credit risks. And was there a response from the financial regulator to that comment from the IMF?
The financial regulator I don't recall any response from the financial regulator. I think if there was a response, it was more likely to come from the financial stability people.
Because that was in the 2006 country report from the IMF, and they did flag a concern with those stress tests that were conducted. But just to come back to that point of the two shock scenarios,
yes.
Can you help us as to why, in an extreme scenario and a weak scenario, in stress testing the bank's books, you'd have a decline in property prices at 40% for both? Why would you do that?
I'm not able to answer that question.
Could it have been that something was suspected as to the quality of the lending in relation to property?
Just to allow to answer there on.
Oh, I wouldn't be able to answer that or to offer any opinion on that.
Okay, well, why was it then in the letters that were written to the banks to conduct this stress test, they asked for special attention to be given to the performance of property and consumer-related lending?
Well, I would have thought that because of the way in which the portfolios of the banks were expanding, that they had picked up on this as in the financial stability department, which ties in with what we were saying earlier on. that this growth in the system is a financial stability, a systemic risk matter, and they must have picked up on that and wanted to have it addressed as part of the stress test. Now, I'm speculating.
And that's what I want to do, Mr. Neary. The operation stress tests were not put in your remit or job description or competency. Is that correct or incorrect?
That's correct.
Okay, so what you're doing is giving an opinion and
I'm giving an
observation on
opinion,
that,
yes.
not a direct account of it.
I'm not able to give a direct account,
Sorry,
Chairman.
Deputy Murphy.
Thank you, Chair. And it's on page 41 of Volume 3 is an email. I won't say who it's from, but it's from someone in the Financial Regulator's office to one of the banks. And it's talking about one of the questions that the IMF wants to look at, in particular, when they come to meet the banks to look at the stress testing that they've done themselves.
Right.
And they want to know how sensitive would specific provisions be to a large drop in house prices, given that the collateral behind the mortgage loan would have to be revalued. We realise that the current level of specific provisions is a very low percentage of the loan, reflecting very low default rates. So, just to summarise, this is the IMF coming into Dublin to meet with the banks following the stress tests that they have conducted, the parameters set by the central bank and the financial regulator, and they too want to focus on a large drop in house prices and how resilient the banks would be to that. Why?
And I just to find
banks would be to a large drop in house prices, and my question is why?
Well, I think there in your introduction, Deputy, if I understood you right, they saw that there was a significant increase in house purchase, lending for house purchase, and very, very low defaults. And I think, as well as that, at that time, with the increases in house prices, there would have been a considerable seasoning in the value of the security. And I can only presume, again, that the IMF wanted to test the resilience of the security and the resilience of the portfolio for a downturn.
And the concerns that the IMF had.
No, Deputy.
Concerns that the IMF had in this was spring 2006. Did you have these concerns?
Well, that exactly ties in to the initiative that we took in 2006 to increase the risk rating on the higher LTV mortgages, because we saw that particular line of business was starting to grow significantly.
Okay, thank you very much.